Hello everyone. In this particular recording, we're going to go through some of the homework problems in the Custodial Fund chapter. This is where we're going to talk about, I should say, the Fiduciary Funds chapter, where we're going to talk specifically about custodial funds and trust funds. So just as a quick refresher, custodial funds are considered the pass-through fund, where basically we being the government, we don't own these assets, but we simply have a responsibility to take in these assets, collect them effectively, and then disperse them to the rightful owner. We're simply a quick pass-through. It's a really quick transaction. Versus a trust fund is more of a long-term relationship. Once again, the government doesn't own the assets, but they have a fiduciary responsibility to manage those assets for the rightful owners. So this first example deals with a custodial fund. And the perfect example of a custodial fund is a county tax collector. With a county tax collector, if you think about it, for those that own a home, you know exactly what I'm talking about. If you don't, this is how it works. So if you own a home, let's say in Palm Beach County or Broward County, and when it comes time to pay your property tax bill, you write one check made payable to the property tax collector, the county tax collector. Now, when you actually sit down and take a look at the details of your tax bill, you are paying multiple governments. You're paying your local city, you're paying your county, you're paying your school district, you're probably paying the water district, maybe a fire district, a whole bunch of special districts. In addition, you might be paying multiple taxes to the county. Maybe you're paying taxes for the general fund, taxes for the debt service fund, etc., etc. Point is, you owe multiple different governments. You may owe 10, 11, 12, 15 governments, but you don't write 10, 11, 12, or 15 checks. You write one check made payable to the county tax collector. They take that money and record it in a custodial fund, and then they take that money and disperse it out to the funds or the other governments where it belongs. Custodial funds do not have an operating statement. They don't earn revenue. They don't incur expenses. On the balance sheet, there is no equity. The only thing you are going to see with custodial funds is cash, current receivable, or current payable at any given time. All right, so here is the situation in this particular example. We have the county tax collector of Suncoast County. They're responsible for collecting all property taxes levied by funds and other governments within the boundaries of the county. To reimburse the county for estimated administrative expenses of operating the tax custodial fund, the custodial fund deducts 1.5% from the collections for the town, the school district, and the other towns. The total amount deducted is added to the collections of the county and remitted to the Suncoast County General Fund. So basically what this is saying is the county is the one that's going to operate the custodial fund. Because the county is actually using their own employees and they're doing all the work, even though town and school district and the other town taxes are collected, we're going to basically collect all those taxes, but we're going to deduct 1.5% off the top. And that 1.5% that we deduct from all the other governments are going to be remitted to the county. We're just kind of reallocating the funds that we're collecting. So here are the total taxes, and you can see the chart. The county taxes $10,333,000. The town of Bayshore, $4,840,000. The school district, $6,550,000. And all the other towns combined, $3,120,000, for a total of $24,843,000. That is the amount of the tax levy. All right, that's just a fancy way of saying the tax invoices that go out to the property owners within this particular county. They're going to be billed $24,843,000 $843,000. Let me show you the journal entries on the custodial fund as well as two of the participating governments. So first of all, in the custodial fund, as I said, no operations, so we're simply dealing with current assets and current liabilities. The journal entry is as follows. We're going to debit a taxes receivable. That is a receivable from the property owners that are receiving the invoices. And we're going to credit due to other funds and governments. This is a liability. So effectively what the custodial fund is saying with this journal entry is, yes, I'm going to bill all the property owners with the tax bills, and as soon as we collect it, boom, we have a liability to either other funds within the county or other governments, like other towns and school districts and whatnot. While that journal entry is recorded in the custodial fund, let me show you the journal entry on the county's general fund. All right, so in the county, if we come back up to that list, the county, how much taxes are theirs? And I'm highlighting it here, $10,333,000. So when the property assessments go out, the levies go out, the general fund is going to debit taxes receivable for the full gross amount, $10,333,000. But remember what we learned a few chapters ago. What governments do is they actually record revenue using what's known as the net revenue approach. So with the net revenue approach, we only are going to record revenue for the net amount we believe we're going to collect. And it says here, and I'll highlight, beginning with the tax levy entry, assume 4% of the gross levy will be uncollectible. So 4% of the $10,333,000 is this $413,320. That is going to be recorded as your allowance for doubtful accounts or your contra receivable. This particular homework problem calls it the estimated uncollectible current taxes. That is simply the contra receivable. The difference, or the 96%, would be recorded as revenue. Now, just a few comments on this contra receivable, $413,000. This doesn't mean that some property owners are just going to skip and not pay their property taxes. No, they would be foolish if they did that because they're going to lose their house. Basically, what happens is the government gives the opportunity for taxpayers, property taxpayers, to pay their tax bill early. And if they pay their tax bill early, they're going to get a discount. So that's effectively what that allowance for doubtful accounts is, really to reserve for a lot of people that are going to pay their property tax bill early and take advantage of that discount. All right, and also I wanted to show you the journal entry on the town of Bayshore's general fund. So if we come back up to the original chart, the town of Bayshore, the taxes levied, and I'm highlighting it here, came to $4,840,000. And so very similar how we just recorded the journal entry in the county general fund. For the town of Bayshore, we're going to record the $4,840,000 as a gross receivable, but as the author said in the in the write-up of this particular part, we have to assume a 2% uncollectability because of taxpayers taking advantage of a discount. So 2% of the $4,840,000 is $96,800. That is your allowance for doubtful accounts. The 98% is going to be recorded as revenue. Okay, and now let's go up to what happens next. So that was simply recording the tax levy. Now some of that money is being collected. And number 2 says $13.7 million of those tax levies are now collected. So that money, where does it go into? That money is going to originally go into the custodial fund. So in the custodial fund, and you can see we're recording journal entry 2 here, we're going to debit cash, and the credit goes to receivable. That is the $13.7 million. Now, what we need to do is we need to figure out of that $13.7 million, what percentage of that goes to which of the governments we're collecting for. So the best way to do that is to put some sort of chart together that looks similar to this. And if you can see, I'm highlighting how to calculate that. So the county, if you go back up to the original $24,843,000, the county was $10,333,000 of it. The town was $4,840,000. School district $6,550,000, and the other towns $3,120,000. So what you're going to do is you're going to take those amounts and you're going to divide it by the total tax levy. That gives you a percentage, an allocation percentage. So the county was $10,333,000 divided by $24,843,000. We will take that percentage and multiply it by the amount of taxes that were actually collected. In this case, $13.7 million. And we get the amount that was actually collected for the county, $5,698,269. Now, what I want to show you is these four numbers in the taxes collected column. If you add them up, let's see who's paying attention. I'm going to ask a question. If you add these four numbers up without doing any calculations, without pulling out your calculator, tell me what these four numbers equate to. Let me give you a few seconds. Okay, if you got the answer, then you're understanding this. If you didn't get the answer in those 3 seconds, then you're still not understanding. So these four numbers are going to equate to the $13.7 million. All we're doing is trying to figure out where does that $13.7 million that we collected, where does it go? Now, we can't stop there and say, okay, this is the amounts that we collected on behalf of these four governments, and we will disperse as that. No, there's one extra step we need to take. Remember what I said earlier. The county is the one that's doing all the work. They have the custodial fund. So as we said in the directions to this particular problem, the county is going to get basically 1.5% fee from all of the participating governments. So let's take as an example the town of Bayshore. We collected $2,669,082 on their behalf. Well, if we multiply that amount by 1.5%, we're going to get this number, $40,036. So we're going to subtract that from the $2,669,000. And if you see the last column, that is the liability that is due to the town of Bayshore. And then you do the same thing with the school district. Figure out 1.5% of the $3,612,000 that was collected. That works out to $54,181. Okay, so the difference is the liability, $3,557,903. You do the same thing with the other towns. Well, if you add up the $40,000 deducted from the town of Bayshore and the $54,000 deducted from the school and the $25,000 deducted from all the other towns, you are going to get this $120,025. That is the amount that's going to be added to the county, and it's going to be subtracted from all the governments that we are collecting for. So really quickly, I'm going to ask you a similar question I just did with the first column. If you add up these four numbers in the 1.5% fee column, what do you come to? And I'll give you a few seconds to figure that out. Okay, if you have your answer as 0, then you are following. All we're doing is reallocating a collection fee. We're taking it away from 3 governments and we're giving it to the county because the county is the one doing the work. And if you take a look at the county, collected $5,698,000 on their behalf, and we're going to plus $120,000. So the liability to the county is more. It's $5,818,000. Last question I'm going to ask you to go through. If you add up the four numbers in the agency's liability column, I'll give you a few seconds to figure it out. Okay, if your answer was $13.7 million right away without doing any calculations, you are clearly following what I'm talking about. Okay, so with this handy table, we are now going to figure out of the $13.7 million that we collected on behalf. What we're going to do in the custodial fund is we can now, journal entry 3, what we're going to do is we're going to debit the big liability, let's call this the master liability, due to other funds and governments. And what we're going to do is we're simply going to break up the big master liability into little mini liabilities due to the general fund, due to the town, due to the school district, due to the other various towns. And where do these numbers come from? And for the mini liabilities, they came from the last column on the table that we just calculated. All right, and then we take those liabilities. If you take a look at journal entry 4, we take those liabilities and we're going to pay them. So we'll debit the liabilities and we will credit cash. So let's take a look at what we do as that is going on in the custodial fund, what happens in the other funds. So for the county general fund, when they receive their money, let's come back up here. How much is the county getting? $5,818,294, but it's broken up into two pieces. A tax piece of $5,698,000 and a collection fee of $120,000. So if you take a look at the journal entry, what is it? We're going to debit cash for the full $5,818,000. Well, the $5,698,000 is collection of the receivable. The other $120,000 is a collection fee revenue. Now let's take a look at the town of Bayshore. Looking at the town of Bayshore, once again, they're getting $2,629,000. It's $2,669,000 is the taxes, and $40,000 is the collection fee. All right, so let's come down to the town of Bayshore, and you can see there it is. The $2,629,000 is the cash, but $2,669,000 was the receivable. The $40,000 is a collection fee expenditure. Do you see how that works? The government that's doing the work, which is the general fund, they're receiving a collection fee revenue, but all the other participating governments, they're going to be recording a collection fee expenditure. All right, so those are the basic journal entries that you are going to see in this situation, and that is basically what we are going to see for a custodial fund. All right, now let's take a look at a trust fund. A trust fund is a fiduciary fund, just like a custodial fund. The difference, though, is a trust fund is a long-term relationship, meaning the trust is going to manage other entities' money for the long period of time. All right, so we have three governments that are getting together, and they're going to pool their investments. We have the city of Albertville, we have the Albertville School District, and we have Richwood Township. So the three governments get together. They decide to pool their investments to invest together for efficiency purposes. Okay, and what's happening here is one of the governments, and it's going to be the city of Albertville, I believe, they are going to be the ones that are going to account for the trust fund. This is important. Not all the governments involved have to account for a trust fund. There has to be one of the parties needs to kind of raise their hand and say, we'll take care of the trust fund. They're called the internal participant. That's important. And the other governments are going to be considered the external participants. That is important because the accounting is different between internal participants and external participants. Okay, so when these governments decided to pool their investments, they decided to pool their investments, and I'm highlighting it here, on February 15th, 2020. And on that date, the city had an investment portfolio with a value of $900,000. The school district had a portfolio with the value of $4,230,000. And the Richwood Township had a portfolio with a value of $3,870,000. Now, you have to remember, governments don't update their investment portfolios with an accounting journal entry every single week or month. Basically, they do it probably quarterly or at least annually. Okay? So the last time, you have to keep in the back of your mind, even though the trust fund was created on February 15th, 2020, you have to realize that the last time these governments updated their asset, their investment asset in the balance sheet was as of December 31, 2019. Okay, so we can see that the balances were different. All right, so the journal entries we're going to record in the three participating governments on February 15th, on the day that they decided to create the pool. All right, let's take the city of Albertville as an example. $900,000 was the amount of money that they are going to transfer out of their personal investment account into the pool. All right, so the city of Albertville is going to create a new asset. They're going to get rid of their investment asset, and they're going to create a new asset. And that new asset is going to be called equity in pooled investments. And you can see the value is $900,000. And now the city is going to get rid of their investment account. It's an asset. Now the investment account has a value that what it was on December 31, which was $890,000. Well, the difference between the new equity in pooled investments and the old investment account, in this case $10,000, this is the revenue account. Okay, this is basically the change in fair value. It's a positive change. That's why the revenue account is being credited. You do the same thing with the school district. $4,230,000 is the new asset, and the old asset coming off the books is $4.2 million. So the new asset is here, debit equity and pooled investments. We will credit the investment account. The difference between the two is an increase in the fair value. That is a credit to the revenue account. Now the Richwood Township, they need help more than anybody, because take a look at them. Their value when the creation of the pool date was on February 15th was $3,870,000. However, on December 31st, 2019, the value was $3,890,000. They actually lost $20,000 in the first 6 weeks of the year. So the journal entry, we're going to put the new asset on the books called equity and pooled investments, $3,870,000. We're going to get rid of the investment asset account, had a value of $3,890,000. Now, in this case, they lost money, so the revenue account, which is the change in fair value, has to be debited. This is not a typo. You might be thinking, hey, how come the revenue account is being debited? Well, it's not a mistake. It's simply because they lost money. All right, so those are the original journal entries in the pool participants. Now the journal entry in the actual pool. So if you add the numbers up, it comes to how much is the investment pool getting? And I have it highlighted here. They are going to receive $9 million. So the investment pool, the trust fund, they're going to debit the various investment accounts totaling $9 million. And it happens to be broken up. U.S. T-notes, $900,000, and CDs, $8.1 million. Those are the original investments in the trust fund. And remember what I told you earlier, that there's a difference in accounting between an internal participant and an external participant. And here it is. The internal participant, in this case, it is the city of Albertville. We're always going to credit a liability account in the trust fund. So you see this liability called due to general fund. Well, this $900,000 liability in the trust fund is always going to equal the equity and pooled investments in this case, the general fund of the city. That is the link between the two. They will always be in agreement. Now, the external participants, we don't credit a liability account, but we're going to credit additions accounts. Now, trust funds, we don't use the terminology revenues and expenses, but we are going to use the terminology additions and deductions. So this is on the operating statement. This is increasing net position, these additions. All right, so only the external participants would actually increase your net position. All right, so that was on February 15th. So the pool has been created. Now, 4 months later, on June 15th, the Richwood Township, they decided to withdraw $3,010,000 because they have a big capital project payment coming up. Now, they haven't locked up their money. Nobody's locking up their money here for the long term. So they are allowed to pull out money anytime they want. So they've decided to pull out $3,010,000. Now, on the same time as the withdrawal, the fair value of the T-notes increased by $30,000. Assume the trust fund was able to redeem the CDs necessary to complete the withdrawal without a penalty, but did not receive interest on the funds. So there's really two things going on here. The first thing we want to do is let's take care of the T-note increase of $30,000. So in the trust fund, we're going to increase the U.S. T-notes, which is our investment account, by $30,000. And what we are going to do is we are going to allocate that increase of the T-notes. We're going to allocate it to the participants of the pool based on their ownership percentage of the pool at this moment in time. So in order to do that, we're going to put a table together that looks something like this. And I want you to follow me here. So in the beginning of the pool, the creation of the pool, do you remember this $9 million breakout? The city put in $900,000. The school district put in $4,230,000. And the township put in $3,870,000. All right, so if we take the city as an example, take their $900,000, divide it by the total of $9 million, they own 10% of the pool. The school district, $4,230,000, divided by the $9 million, they own 47% of the pool. And the township, Richwood Township, $3,870,000, divided by the $9 million, they own 43% of the pool. So when we get a T-note increase of $30,000, we're going to take that $30,000, divide it, or multiply it, by their ownership percentage. So the city, $30,000 times 10%, they're going to get $3,000. The school district, $30,000 times 47%, they're going to get $14,100. And lastly, the township, $30,000 times 43%, they're going to get allocated $12,900. So remember these three numbers, $3,000, $14,100, and $12,900. So if we take a look at the journal entry in the trust fund, here it is. Here are your credits. we will credit the liability due to general fund for the city's piece of $3,000, and we will credit additions for the school district and the township's allocation of that $30,000 increase in the T-note value, $14,100 and $12,900. Now let me show you on June 15th what the journal entries would look like on the 3 participants' records. So here is the city of Albertville. They're getting $3,000. Debit equity and pooled investments, credit revenues, and the same thing on the school district. Debit equity and pooled investments, credit revenues for their piece, and the same thing with Richwood Township. Same journal entry, different dollar amounts. Now the second thing that is happening on this date is the trust fund is cashing in a CD for $3,010,000, debit cash, credit CDs, and they will immediately take that $3,010,000 and they will basically send it off to Richwood Township. Remember, they are the ones that requested the withdrawal. So the trust fund is also going to debit deductions and credit cash. So the journal entry also on Richwood Township, in addition to their $12,900 allocation of the $30,000 increase in the T-note, they're also going to receive a cash distribution of $3,010,000 debit cash, and their investment, their equity and pooled investments, goes down. All right, so that's the journal entry. But I want to show you one more thing. Because the Richwood Township took a withdrawal of $3,010,000, now what's going on in the portfolio? Basically, what you want to do is every time there is a new contribution coming into the pool or there's a distribution coming out of the pool, we need to stop and we need to reallocate or recalculate. That's a better word. Recalculate the ownership percentages at this particular moment in time. So the city, they originally had $900,000 and they were allocated $3,000 for the T-note distribution. So their new equity and pool investment is $903,000. The school district $4,230,000 and they received $14,100 from the T-note. So their new equity is $4,244,100. The township, they started with $3,870,000. They got $12,900 from the T-note distribution, but we have to subtract out their withdrawal of $3,010,000. What is their new equity? It's down to $872,900. When you add up these three numbers, the new portfolio balance is $6,020,000. So reallocating the ownership percentages, let's take the city, $903,000 divided by the total of $6,020,000, we get 15%. The school district, $4,244,000 divided by the $6,020,000, wow, they now own 70.5% of the pool. That's a lot. And the township, $872,000 divided by the total of $6,020,000, they're going down to 14.5% of the pool. All right, so these are the new ownership percentages. So on a go-forward basis, whenever we have increases in fair value or dividends or interest to distribute, we're gonna allocate based on these new ownership percentages. All right, so let's see what happens after June 15th. We have a few things going on. On September 15th, T-note interest was collected in $50,000. So the trust fund is going to debit cash and credit this temporary account called undistributed earnings. All right, that undistributed earnings, it's a temporary account. It's just kind of a placeholder for that because we will distribute it before the end of the year. And also on September 15th, we had some CDs interest that wasn't collected, but it was accrued at the end of the year for $28,000. So we're going to debit accrued interest receivable, $28,000, and credit this undistributed earnings. So between September 15th and year end, December 30th, if you add up the amounts in the undistributed earnings, it comes to a total of $78,000. And by the end of the year, we're going to take that undistributed earnings of $78,000. We will get rid of it with a debit, and in its place, we will allocate that $78,000 based on the ownership percentages at this moment in time. So let's come back to our handy table, and we'll take the $78,000. You can see I'm highlighting it here. We will take our $78,000 that we're trying to allocate to the pool participants. So if we take $78,000 divided by the city's percentage of 15%, we get $11,700. So we will come back up to the journal entry. If you come back up to the top of your screen, we will credit due to general fund for that $11,700. The school district, they're going to get $78,000 times 70.5%. They're going to get allocated $54,990. And lastly, the township, $78,000 times 14.5%. They're going to get allocated $11,310. And so those are the credits to the additions accounts for the school district and the town. And taking this journal entry here, remember these numbers, $11,700, $54,990, and $11,310. You will see that on the last day of the year, we will debit equity and pooled investments and credit revenues across the board for all three participants for their respective amounts that they share in the $78,000 earnings between September 15th and the year-end interest accrual. All right, so it's basic. There's a lot of moving parts here with trust funds. There's a lot of moving parts. But the good thing is, if you just really zero in on it, what's going on here is a bunch of governments get together, pool investments. One of those governments needs to volunteer and account for the trust fund on their books and records. They're called the internal participants, and everybody else is an external participant. The internal participants, whenever they get an allocated share of interest, dividends, fair value increases, what have you, we will credit a liability in the trust fund. The external participants, on the other hand, we will credit additions and not a liability. So the accounting is different. But please understand the flow of the trust fund, its journal entries, as well as the journal entries of the participating governments. And let me go through one more with you. I want to show you it's very simple, all right, but I need to explain a couple of things, all right? It is simple, but it does need explanation. All right, so we have a county, Evergreen County. They act as a dispersing agent for a state grant for the performing arts. The state, now not the county, we're talking about the county in the first sentence. In the second sentence, we're saying the state, which is a completely separate government entity. The state is responsible for determining which governments are eligible for the grant money and for following up to ensure the recipients comply with the requirements of the grant. The county receives the grant funds and disperses them according to the schedule provided by the state. When the county was asked to participate, the county's attorney was concerned that the county might be held responsible for any disallowed costs. Therefore, the state agreed to accept responsibility for any disallowed costs, so the county decided to act as the custodian for the state for this grant. This is a loaded paragraph. There's a lot of things going on in this paragraph. Basically, what's going on is we came to the final conclusion from reading this paragraph that the county has no responsibilities, no decision-making responsibilities whatsoever. They are responsible for grabbing a schedule from the state and along with a check and taking that check, depositing it in a custodial fund and dispersing it according to the state's schedule. They don't need to monitor any of the recipients. They don't need to make sure that the recipients are spending the money in the rightful way, which is what you really have to do with grants. They don't have to do any of that. The state has decided to do that and take full responsibility. That is why the county has decided they can use a custodial fund, is because of the lack of any responsibility on their end. Now, because they're using a custodial fund, really simple, you can see that the state gives the county, Evergreen County, a listing of $5 million. They give them a $5 million check, and then they give them a listing of how the $5 million needs to be dispersed. City of Boulder, $2.1 million. Aspen Township, $1.4 million. Snowton, $900,000. And Fir Tree Village, $600,000. So the journal entry is really simple in the custodial fund. First, the custodial fund is receiving those monies. Debit cash, credit the various liabilities. And then those liabilities would be debited, and we're going to credit cash. We're basically taking the money, all right, recording the liabilities, and then taking those liabilities and paying them. That's what we are doing here. We are showing the monies as a debit to cash, credit to liabilities, and then paying those liabilities. Okay, and then of course there's going to be a follow-up journal entry. All of the amounts that were collected are going to be shown as an addition, and the amounts that were paid out are going to be shown as a deduction. It always nets to zero. With an agent, with a custodial fund, it's always going to net to zero. One last thing that I want to talk about in this particular transaction is this. I'm going to throw a what if question at you. What if the county decided to accept responsibility of monitoring the recipient's spending of their award and making sure they're in compliance with the grant contract and all that stuff? Well, at this point, it's no longer a custodial fund. At this point, when the money is received from the state, they're going to record it probably in the general fund as revenue. And then when they disperse it out to the participating governments, they would record an expenditure. So it depends on what's going on here. All right. In this case, it's a custodial situation. But you have to read to make sure that there is truly no management decisions that need to be made. Simply just following directions of a schedule. And that's how you know you have a custodial fund.